Hello everyone to whoever is watching this. Today we will be talking about our TER projects, which underlines under the analysis of credit risk and the modeling and calibration of the yield curves. So a brief introduction to the subject. Since the early beginning of interest rates related assets, such as loans, mortgages, etc. Modeling the yield curves dynamic has been a crucial part for managing portfolios exposed to interest rate movements, because these assets are intimately related to the interest rates. We can imagine that any move in the interest rate can affect these class assets significantly. Thus, the need for a crucial and an accurate modeling of these yield curves so we can better comprehend our risk management strategies and our portfolio management strategies. While the Black-Scholes model is the go-to for modeling equity assets such as stocks, interest rates, assets, and derivatives often differ significantly from equities in many characteristics, and especially in the maturity date T, which is significantly higher in the interest rate class assets and can go up to 20, 30 years, making the use of the Black-Scholes models unrealistic in most cases. Therefore, the need for more accurate and precise models for interest rate class assets, which have continued to occupy efforts from both researchers, academics, and practitioners, which have led to the introduction of the Vasicek model, for example, which is the base model, the TER model, which Bilal will talk thoroughly later on in this presentation. So for the regulatory context, in an insurance context, and more particularly in life insurance, credit risk is one of the main metrics and risks insurance have to take into account as part of their risk management strategy. It mainly affects corporate bonds, which are generally the products most commonly held by insurers. These insurers companies are conform to regulation imposed by the regulating authorities such as la CPR, and these regulations are included in are all included in a directive called the Solvency II, which have entered into applications since January 2016. So what is the Solvency II directive? Well, it's a set of regulatory requirements implemented by the European Union to standardize and strengthen the prudential regulation of insurance companies and ensure their financial stability, also prioritize client satisfaction and protection, and make the business of insurance and the players in the insurance business make the competition more fair and the regulation more clear. These requirements are divided into three main pillars that are the quantitative requirements, which have introduced many metrics such as the best estimates, the SCR, the solvency capital requirements, also the MCR, the minimum capital requirement at the URSA. All these metrics have different formulas under many insurance fields, whether it's life, non-life insurance, etc. We have also the qualitative requirements and the supervisory review process, which guarantees transparency and authenticity in operating in the insurance business. Also, the credit risk theory. We define the credit risk associated with the debtor inability to pay, resulting in a financial loss. A portion of this loss can be recovered through legal procedures, actions, and by subscriptions to multiply insurance, such as the CDS insurance. The amount recovered from the total loss is referred to as the recovery amount. Thus, credit risk consists of the main following risks. So we have the default risk, which is the risk that a borrower will be unable to pay his debts. We have the downgrade risk, which is the risk that our bond or our stock will be downgraded in rating, passing from AAA to B, for example. And we have the counterparty risk, which is the risk that the counterparty in a financial transaction will default and fail to fulfill their obligation of reimbursing their debts. Also, for the loss given and the recovery rates, We have the loss given defaults given by the formula. So it's 1 minus alpha multiplied by 100. Alpha being the recovery rates, which is a fraction from 0 to 1. So the loss given defaults noted LGD is a percentage between 0 and 100, and it represents the portion of the exposure there it's not recovered after default. So for example, if we have 100,000 euros loan and there is a default by the borrower, so if the loss given defaults is 20%, we won't be able to get 20% of the payment, which is 20,000 euros, for example. So for the spread is the difference between the yield of different types of fixed income securities. Usually it's a benchmark and the risky fixed income security. It represents the compensation investor demand for holding securities with higher risk compared to risk-free securities. And the formula is given by the yield of the corporate bond minus the yield on the treasury bond, where the corporate bond is the risky one and the treasury bond is the benchmark. So in the European Union, the benchmark is usually the German bond or the German government's bond. So for the pricing of our zero coupon risky bond, we define the differential of our risk-free assets by DBT. So it's the interest rate multiplied by BT. So as a consequence, BT is the integral of the interest rate. So we have to integrate for both parts. Also, we introduced the deflator or the discount factor as the fraction between B value to the maturity under B value to the time T. And thus, the price of our zero coupon is just the expectancy under the neutral probability of our deflator, because we have a 1 euro nominal value. So if we had 1,000 euro, for example, we will just multiply by 1,000 because the expectancy is linear. So by calculating the cash flow for our zero coupon bond, we find the following formula. So the cash flow corporate is given in a formula where is the recovery rate, the deflator, and the loss given default. Thus, our price for our corporate zero coupon bond is the expectancy under the neutral probability of the cash flow. By using the filtration change lemma, we find this formula for the price of our corporate zero bond. And then by certain operation, we find this formula for our corporate spread, which is given by the LGT under the maturity T minus the time T, where lambda is a deterministic intensity of Poisson, and T is the bond maturity. And we emphasize on this formula because it will be used in our spread modeling, in our optimization algorithm and our model validation process. So I will now let Bilal introduce the VADICheck, the CER model, and the calibration and validation process. And then we will have a small conclusion where we will thank our tutor and the people that contributed to this project. So I will stop sharing and I will let Bilal go through his parts. Okay, so you can go, Bilal. I can see the screen recording.
Thank you, Youssef, for your introduction. Well, in our project, we utilize specific rate models to ensure compliance with Solvency II regulations. And like I said, we use two specific models to modelize interest rates. The first model was VASICheck, who is the most common and more basic model. And the second was Cox-Ingersoll-Ross, is really close to VASICheck, but is a little less complex, a little bit more complex. These two models are widely trusted in the financial industry due to their proven accuracy and robustness in risk assessment. And they are also foundational. For me and Youssef, our priority in this project was to improve and upgrade on the financial sector, and it was a must to understand these two models. And with these two models, we made a calibration and And the calibration is the process that adjusts a model to align closely with data, and the data is the interest rate of each maturity. And like you can see a blue curve and red curve, and the red curve is the interest rates, and the blue is the model, and the goal is to minimize this difference between the rates observed and the rates with the diffusion parameters. And with this calibration, we can measure the risk which the insurance company is exposed. We have used two methods of ordinary calibration. The first was ordinary least squares. This method is the most used and the most common. It is this formula, and is really efficient, but she's a little bit sensitive to the outlier. And the second method is the maximum likelihood estimation. Here, the method is to maximize the probability to find the data of interest rates, and to find the diffusion parameters who does that. And at the end of the project, you can see a method validation. After all the calibration, we have to validate our calibration, and for that, we used the Martingale test. The principle of Martingale test is to verify that the residuals or returns from a model cannot be anticipated from past data. There is a form of independence of these two data between the prediction and the data. And this is a summary of our project, and this is the end. And we would like also to thank Anero, because she was very kind with us, and she gave us a lot of help, and we would like to thank her.
Okay, so I will also like to thank Madame Anero for providing help in this project, although we had a very tight schedule. And I would also like to thank Bilal for doing this project with me. And also, finally, thanks to Ahmed, which is also an actuary student, a friend of mine, that also helped us understanding certain formulas and the definition that we implemented in our projects. So thank you, everyone, and have a good day. Thank you.